moment. So US Treasuries, they typically give positive returns after final rate hike. And at the current levels, they offer also very attractive risk reward for investors to consider. And historically, these are some of the charts to show that even at the current level, as long as investors hold on to treasuries over time, they will be able to make money due to the coupons payment as well as the pull to par effect, or we call the capital appreciation. So hence, treasuries will always be one area in fixed income that we are we are most positive on at the moment. And moving on to the next slide, we also have a chart that talks about the returns of the investment grade bonds and also the returns versus equities during various periods of market stress. So on the next slide, you're able to see the chart and two bars. So Elias, next slide, please. Yes, thank you so much. So the blue bars represent the returns of investment grade bonds, and the orange bars actually represent the return of global equities. And it's quite apparent that during periods in the past, when equities fell more than 15%, returns of investment grade bonds were typically flat to positive. So that's actually a demonstration that having investment grade bonds in a portfolio can help investors to diversify risks within within investors' overall allocation or portfolio. So high quality investment grade credits will be another area that we are very positive on for that diversification benefits. So moving on to the next slide, I think against such a very challenging backdrop, there is a strong case around fixed income, particularly higher quality government bonds and investment grade credits. And what we want to bring to our attention today is actually our Fidelity US dollar bond. It is a simple, very high quality portfolio that captures some of the very attractive opportunities that we talk about in the space right now. So on the next slide, you will be able to see the key selling point of this fund that we have put together. And it can be summarized into three letters, U, S, and D. So on the next slide, U actually stands for our unbending quality. So it is a very high quality core defensive fixed income strategy that we are talking about today. It is predominantly invested in high quality bonds, in US Treasuries mainly, and there will also be some allocations towards developed markets, large cap investment grade credits, and here the allocation will mostly be in the US as well. So US Treasuries and also very high quality exposure to DM large cap IG credits. And the fund also has no exposure to securitized assets like asset-backed securities or mortgage-backed securities at the moment. So it is a very simple, very pure allocation kind of a strategy. And the fund on average also have a very high investment grade rating. So historically, the credit rating of the fund has always ranged between A+ to AA. And so that's really summarizing our unbending quality for this fund. And S actually stands for our strong track record. So the fund was actually launched in 1990. The fund really has a very long runway, a very long track record. And it has also managed to deliver first quartile annualized performance over the longer term. And there was no defaults ever since our PM took over the strategy. And even in the short term, annual returns have also been consistent across the cycle. And the fund has also outperformed its benchmark across all calendar years on a gross of fees basis. So that's really, the performance really speaks for itself for this strategy. And D stands for dynamic and flexible approach. So the fund is being run with a very high conviction, contrarian and nimble approach. So for us, we always try to identify turning points in different parts of the fixed income markets. And always we try to stay ahead of the market wherever possible to get those alpha opportunities and for us to outperform. And naturally, the fund will have a very high credit quality by nature of its allocation, and also a longer duration profile as well. And within this mandate, the fund has also demonstrated its ability to be very nimble with its portfolio positioning and adjustments as well. So I mentioned about longer duration profile. So right now, the effective duration of the portfolio stands at 6.9 years, so roughly 7 years, slightly on the longer end. On the next slide, I have another slide around the experienced investment team. So the fund is managed by a very experienced team of 3. So you can see some of the faces that we put behind the wheel of running this strategy. So the lead portfolio manager is Rick Patel. He has more than 20 years of investment experience, and he has been managing this strategy since 2009. He is also the lead PM of several of our other global mandate or global strategies at the same time. And moving on to the next slide, we also have we also have a slide to showcase some of the tools we can use to construct this very high quality fixed income portfolio. So not surprising to see that the most of the allocation will actually be towards government bonds. So these will be mainly US Treasuries, which is the largest and also the most liquid part of the fixed income market in the world. We also have a selective allocation to other major government bonds like UK, Australia, or Germany. And at the same time, we can also have some allocation towards large cap global IG corporate bonds, mainly in the US as well. But we also have the ability to have selective allocation to other developed markets. But the emphasis for us is really on large cap bonds, which tend to be the most liquid part of the market. And again, the emphasis for us is about safety. The emphasis is about liquidity. At the same time, we can also take some small selective positions in different satellite components. So examples will be emerging market bonds as well as high yield bonds when we find valuation become very attractive or when the opportunities arise. But rest assured, be it emerging market bonds or high yield bonds, these higher yielding higher, in a sense, riskier components will not exceed 10% of this fund respectively. And moving on to the next slide, it talks about our flexible and dynamic approach. So this will be a slide that shows the historical asset allocation of the fund over time. So on the left-hand side, while you can see that the fund is predominantly invested in government bonds and investment grade credits, the high quality ones, but allocations can swing quite a bit and quite quickly as well when we see the opportunities arise. So we can technically trade around the satellite components in high yield and EM as well. So the story for us is always very consistent. At the moment, you will be seeing the majority of the allocation being placed towards treasuries, the high quality investment grade credits, and we also have very minimal allocation towards emerging market bonds and high yield bonds at the moment. And again, the emphasis for us is really around the safety, quality, and liquidity as well. And on the right-hand side, you're able to see the absolute credit rating. So from a credit rating point of view, the fund tends to have a very, very high credit rating. So over the past 5 years, the rating has ranged between A+ to AA. And it is very clear that we are not hugging the bottom line when it comes to quality. We are not hugging the BBB around that range. We are very, very high up in the quality spectrum. And when it comes to absolute duration, at the same time, the portfolio also has a more defensive, longer duration profile due to its treasury and IG credit holdings. So duration in recent years have ranged between 6 to 8 years and slightly on the longer duration end as well. But back to a bit of Finance 101, duration is really the sensitivity, is really the measure of sensitivity of bond prices to any changes in interest rate. So we know they tend to move in opposite directions. So when interest rates are expected to fall, bond prices will actually rise, and that's when we will be able to see some pull to par effect or price appreciation opportunities, and that will benefit our portfolio, our holdings, and vice versa. When the interest rate rise, bond prices will actually fall. So if we know that the Fed's going to cut interest rate this year, bond prices will naturally increase, and this is really when portfolio can benefit from that. Capital appreciation opportunity and the conviction around long duration has also become quite a consensus, actually more and more consensus in the market at the moment as well. So I talk about the positioning and also we mentioned briefly just now, if we can move on to the next slide, performance of this strategy really speaks for itself. On the next slide, you will be able to see the strong track record of the outperformance that we have with this strategy. We have demonstrated our ability to outperform the index very consistently in all kind of market conditions, including the very challenging ones in the past as well. And across a fees basis, the fund has always managed to outperform its index every calendar year through our portfolio manager tenure since 2009. And there were no defaults. Since the PM took over the strategy, the annualized return of this fund is 4.0%. Again, a strong demonstration of our portfolio manager skill and expertise, and also how strong the performance is for this fund. And even on the longer term, on the next slide, we have also demonstrated, from a risk-reward perspective and in relative terms, how we manage to outperform. So on the left-hand side, you'll be able to see when we measure and compare ourselves against the global aggregate index and also the high yield index. So from a risk reward perspective, the fund has done much better than global IG. And even compared to high yield bonds, of course, the returns will be lower because of the lower risk we are taking. But we are at the same time taking much, much lower risk as well compared to the high yield index. And the returns wise on the right hand side, the fund has managed to outperform the index across all market conditions, as mentioned, across the fees. And again, very strong, very stellar kind of a track record we are talking about for this Fidelity US dollar bond fund. On the next slide, we will also like to show you some of the asset allocation and our sector preferences at the moment. So you will be able to see on the left-hand side that our current asset allocation breakdown. So as mentioned, the majority of the allocation is currently placed in government bonds. So about 56% of it is actually placed within the government bonds, and specifically US Treasuries will be the most of our holdings. And we also have another 40% in IG credits. So these will be really the high quality IG investment bond credits we were talking about. And the largest overweight for us at the moment is actually towards the financial sector. So we have 22% of allocation in financials at the moment. And allocations in financial here, we are talking about high quality banks, which are very well capitalized. So these are what we call globally systematically important banks, top tier national champion type of banks that employ many, many people and are structurally important to the economies they're in. So they also have the better and greater ability to stand any slowdown. So banks we are talking about will be BNP, Morgan Stanley, JP Morgan, and these will be some of the holdings that we have in the strategy. And outside of financials, the fund is currently underweight the rest of the investment grade credit market because of valuation reasons. These are where we feel valuations are quite expensive at the moment, and liquidity is also falling quite significantly. And we actually have been taking profit in rotating into some of the treasuries to increase the liquidity within the fund. So again, we talked through the asset allocation. So the story is highly consistent for us. A majority of the allocation, up to 90%, is invested in government bonds and high quality investment grade. And within IG credits, our preference will be towards the financial sector. That's where we are expressing our preference and placing our overweight at the moment. And outside of government bonds and investment grade credits, we have less than 1% in high yield at the moment. And this is also a place that we have been reducing further, again, to boost the liquidity and quality of this profile. And less than 1% is, to be honest, quite negligible. And we also have a 2% very minimal allocation in emerging market as well. So, other than that, we have a 0% exposure to securitized assets. So no asset-backed securities or mortgage-backed securities at the moment. Very, very high quality strategy we are talking about. On the next slide, I would also like to talk about our duration positioning at the moment. So duration, as mentioned, it is the measure of sensitivity of bond prices to changes in interest rates. And again, our portfolio is currently overweight when it comes to duration. And on the next slide, we also have a snapshot of how the portfolio is currently positioned. So this will be sort of a summary slide whereby we keep some of the key stats. So our asset under management today is well above 3 billion. So we are a very large sort of a dollar bond in the space. And again, our duration is overweight to benchmark, sitting at 6.9 years at the moment. Is also set to benefit from any potential rate cut scenario. And our average rating is AA minus at the moment. Very high quality, very high up the quality spectrum, definitely not hugging around the BBB range. And by mandate, the fund is always going to be very high quality by nature. Our high yield and emerging market allocation will never exceed 10% each for this portfolio. So I've talked through really our allocations, our positionings, our preferences, and also, I guess, a bit of a macro recap when it comes to what's been happening out there in the market. And the last slide I have for today is actually a very exciting slide. It's about our monthly payout that investors will be getting for those of you, or for those who are investing in this strategy. So I know that for our Singaporean investors, payout, our monthly income is always something that we all will be very interested about. And when it comes to income that investors are getting through this fund, we do have 2 monthly payout share class available. So both are for Sing dollars, and the latest payout we have for the M income share class is around 4.5%, very decent. And we also have a slightly higher payout share class available for those of you who want to have a bit more income on a monthly basis. And that share class is currently paying more than 6% at the moment. So I would say a 4 to 6% monthly income is very attractive, very decent, especially for investors who want to enjoy quality, safety, and income at the same time. So with that, I've come to the end of my presentation, and I'm very really thank you everyone for sitting through the session with me, and I'm very happy to address any questions that you may have in the chat function.
Thanks, Rui Tong. Yep. So now we'll open the ground to see if our clients have any questions regarding the fund or any macro questions. Please feel free to just put inside the chat box and then we will answer it.
Elias, trouble you to see, help me see if there's any questions coming our way.
Yeah.
Sorry, come again?
Yeah, we're waiting to see if there are any questions. Please elaborate more on the sales charge. Okay. For sales charge wise, right, if you were to buy online, say if you buy straight from YouTube platform, there won't be any sales charge applicable. Yep. So I will just perhaps just something that if you're receiving advice from any of your TRs, then you know you're paying for the advice and all that. That's where the sales charge might come in. So it can be purchased via the YouTube platform itself. So unit trust in general works a bit different from your stocks or your ETFs, because stocks and ETFs, right, you're seeing the live pricing and all. While for unit trust wise, it's still traded on the platform itself, but it's on a forward pricing basis. Basically, the price that you're currently seeing on the platform is actually not the traded price. You usually get it in T+2. So I have just a bit explanation on the difference between the unit trust and your stocks and ETFs. Fund management charges. Just let me go back to that. I think it's this page, right? Yep. This is the.
A second.
Oh, wait, is it this page or do you know what's the fund management charge?
It's 0.75%. That's the total annual management fee that we are charging. So I would say it's slightly lower compared to some of the very famous income funds out there.
Yep. Yep. So if you were to buy unit trust off the YouTube platform, there are actually no platform fees or charges. Uh, Unlike when you trade stocks, there's a brokerage fee. For unit trust, there isn't. So last charge, which is relevant for new investors. I'm not sure if you mean the dividend chart.
I can explain a little bit more on this, slide 25, right? I think both share classes are actually relevant to investors depending on your tolerance, or sorry, your preference for income and also tolerance for NAV fluctuations. So the share class you will see on the left-hand side, the M income share class is actually the one that's most reflective of the coupons and the yields we are getting, the natural underlying yield of the portfolio. So that one will be the most reflective of natural yield, and we will try not to dip into your capital gains or dip into your NAV for the payout. So we will the most natural one. On the one you see on the right hand side, the MCDs share class, that's the higher payout share class we are offering. So that has the potential or the ability to dip into capital gains in order to boost a higher kind of like yield for investors. So I guess that's roughly the two differences for the two share classes. So it really depends on your preference for income, how high a monthly income you want to get, and also tolerance for NAV fluctuation. So I guess the two share classes will be for different purposes when it comes to consideration.
Yep. So I think that also answers one of the questions. Imminent they'll lose capital if the fund management is dipping into the capital.
So I would say that if you are seeing the M income share class on the left hand side, is currently paying out 4.4%. So that's the latest payout that we offered to at the start of February. And our natural underlying portfolio yield is actually at 4.5%. So I guess investors can really rest assured that we are trying our best to not pay out from capital or capital gains, and we do leave that a bit of a buffer every time. And for the MCDs, that's where we do have the flexibility to dip into capital gains time to time. Yeah.
The fund cash only, or is this one available for CPF, SAOA, or SRS? No, right?
This one I need to check back with you, but I believe it's cash at the moment.
Yep. What is the current yield? So yeah, I think the current yield right now is actually in the screen here. So on February itself, it was said to be 4.41% for the share class on the left, and 6.11 on the right, depending on the share class that you choose.
Um,
Um, FN fees. So the fund management fee is 0.75%. So expense ratio wise, if you talk about the total fee itself, again, I think for Fidelity, other than your management fee, the fund doesn't charge any other fees, right?
No, that's the only fee we charge
Yep.
is the annual fee.
Correct. So that's 0.75% is the expense ratio itself. Current yield based on today's price, not historical NAV. Would you happen to know that, Yutong?
Sorry, can I trouble you to repeat the question again?
The current yield based on today's price and not historical NAV.
The yield will be as of the payout date, I believe. So let's say usually the payout date every month will be start of the calendar month. So I guess the yield will be calculated based off the yield at that the NAV at that point in time.
Yep. So it's not calculated on a daily basis. How do you? Sorry, I'm not exactly sure what you might mean for how do you sell. But again, for the fund itself, you can either buy straight from U-Trade platform, or you can always approach your TR, or you can approach me. I can assist to put the fund through via pen and paper as well. So up to you. If there are no rate cuts this year, how will this affect the performance of the fund?
I guess sorry. If no rate cut happen, which I think as a firm, and I believe this is pretty much the consensus in the market as well. And I think in the latest FOMC meeting, the Fed has also hinted quite obviously that there will be a rate cut coming. But of course, as a long duration profile, hypothetically speaking, if we don't see any rate cuts coming our way this year, the prices of the holdings we are holding on to will definitely fluctuate a little bit. But again, hypothetically speaking, we don't think any rate hikes will be likely for the rest of the year, and the rate cut will still be the most likely scenario that will pan out for most of us for sometime this year. I guess to ask the question is really how aggressive the rate cuts are coming and how many cuts we will actually see in the market. I think that's the biggest, I guess, uncertainty that the market and all the investors are very keen to understand a bit more on.
Do we get regular reports? I'm not exactly sure what regular reports wise. Does Fidelity on the website publish regular reports?
Yes. So if you just Google search Fidelity Singapore, so we do publish our fact sheets and all the relevant materials on our website. So I guess that's the quickest way for any of us to download and access all those information.
Any minimum or what's the minimum investment? It's 1,000 USD or another SGD, depending on the share class that you choose.
Yes, that's right. I think dollar will be 1,000.
Yeah. Are you able to comment on the Mint USDC? Not actually. USDC share class. I think that's what it means. Sorry, I'm not exactly sure what you mean by are you able to comment on this fund, but maybe you want to just briefly go.
Yes, just give me a second. I'm trying to pull out some data for US dollar bond. For US dollar share class. Just give me a quick second. Actually, for our US dollar bond, we don't really have an M income US dollar share class available at the moment. We only have an MCDist US dollar share class available. So it's the higher sort of a payout share class we are looking at. Only that one is available for US dollar investors. And the most recent payout we are looking at for US dollar in February, early Feb, is 6.2%. So quite similar to Sing dollar that we see on the screen.
So the max cap to high grade or the EM wise, HG or EM wise, is it for each of the category?
Yeah, so if you just trouble you to scroll back one slide. So on the key portfolio characteristics slide, you can see some of our slide 24, please.
Slide 24.
Yeah, I think 2 slides back. Yeah, so on this slide at the bottom, the last row of the table, we lay out some of the indicative investment parameters. So you can see that for us, max 10% in high yield and max 10% in emerging markets. But we've never come to even close to the limit because, as I mentioned during the presentation, by nature, by design, this portfolio will always be very high quality. So that's intentionally kept at a very minimal level for high yield and emerging markets. But we still have a bit of leeway to capture some of the interesting opportunities when we do see them arise.
So for bonds wise, do you recommend 40% of a portfolio to be inside bonds?
I guess we're talking about a 60 equities, 40 sort of fixed income allocation, the typical 60-40 allocation. Is that right?
I would think so.
Yeah, so I guess it will really depends on any investor's preference for risk, and also it's really back to the investment needs and the interest end of the day. I guess this is a very difficult question to answer because I guess everyone's portfolio is will be looking very different at the moment. So I wouldn't apply a broad stroke to say that you should do 60% equities or 40% fixed income. I guess end of the day, it really depends on the risk tolerance that you are looking for. But for those investors who are naturally a bit more risk averse, who want to prefer a bit of a higher quality, safer, relatively more stable kind of allocation, I would of course suggest to dial up their fixed income allocation. And by fixed income, we also have the higher quality treasury government bonds or investment grade credits. We also have the higher yielding, higher risk, kind of a high yield sort of a portfolios as well. And again, with all the current happenings, really the backdrop we are talking about in the market today, I think there's no harm to really maybe focus a bit more on the higher quality and the more liquid kind of portfolios, like what we are sharing today. So that's really as a firm, that's really where our highest conviction is.
Yep, I think for UOBkh and ourselves as well, at the current moment, given the current market situation, we do recommend investment grade bond funds, and lesser on the high yield fund itself. If there's a recession or hard landing, is it right to assume that this fund may perform better than equities?
I would say so, backed up by statistics and historical trends. So if we are to scroll back to slide 14, and that's really where we show, a bit of diversification actually helps on slide 14. So we can tell that during really volatile episodes for the equity market, and this is where like investment grade bonds and treasuries will be shining. Because firstly, these, especially for treasuries, this is really the end of the day, the risk-free asset we are talking about. And also, when the broader equities are not doing so well, bonds typically shine as a result of a flight to quality. And also, it's always the ultimate kind of like safer allocation that investors will be looking out. And again, during any rate cut scenarios, our longer duration profile will also benefit from a better kind of like a pull to par effect. The price appreciation will be greater as well for our bond portfolio specifically. Yeah, I hope that answers the question.
Right. So could you explain what happens to the yield when the Fed really cut rates?
So bond yields actually kind of like linked to interest rates, right? So when Fed cuts interest rates, that's when bond yields will trend down as well. But because of the negative correlation between bond yields and prices, when bond yield drops, the prices will actually go up. So that's where we will see capital appreciation or price appreciation opportunity for this strategy. And it's quite intuitive, right? Let's say and that's why we always sort of advocate for locking in the high yields, high bond yields that we are getting today before rates trend down, because it's quite intuitive. Let's say you are getting, let's say for fixed deposit, for cash deposits with banks, if you know that the rate's going to come down, I think the only intuitive and logical thing for everyone to do is to go to the bank and then place your deposit today before the rates actually come down. So I guess that's the same logic for bonds, bond holdings and bond strategies as well.
The monthly payout is in what currency? So if I'm not wrong, it's the currency of the fund itself. So let's just say if you buy SGD, your payout will be in SGD as well. So is there any period the fund stop payout?
No. So for the share class, for the monthly income share class that you'll be getting, there will always be a monthly income that's paid out to you.
Yep. So I hope I answered the question regarding the currency which is paying out. So basically, if you were to buy the USD one, it will pay out in USD, and if it's actually SGD, correct, Vito?
Yeah, thanks, Elias. Yeah, that's right. So if you are investing into that Singapore dollar share class, you'll be getting the Singapore dollar monthly payout as well. I hope we have addressed most of the questions already.
Yeah, I think so. Okay. So, anyways, if you have any other further questions, you can always drop me an email. Again, my email is eliasteo@uobkn.com. It's ILIASTEO at uobkn.com. Alternatively, you can always contact your TR who is in charge of your account. You have any questions for him, he can always come to me as well. So, you know, any closing statements for your fund itself?
I just want to thank everyone for sitting through the session with me quite late in the afternoon. I wish everyone all the best really the upcoming months and quarters. And also, again, I just want to emphasize the case for quality, case for safety, the case for reliable income, not just high income, but reliable ones and high quality ones as well, and also the need for diversification if if you are sitting quite high on equity allocation at the moment for your portfolio. So yeah, but again, that will be everything, and thank you everyone for your time and all the
All right.
questions.
Thank you,
Like these
Tom.
are all amazing questions. Yeah, thank you,
Yeah, I think
Elias.
no further questions. So yeah, thanks you, Tom, and thanks everyone for attending the webinar tonight. So have a lovely evening. Thank you.
Yeah, thank you everyone. Bye bye.